kind of impact do upcoming elections have on the markets? The CFP board, the Certified Financial Planner board, did a research study recently. I'm looking at my phone here, but I have some interesting stats. They said that, let's see here, 4 in 5 Americans expect that their personal finances will deteriorate should their preferred candidate fail to win the presidency. So about 80% of people think if their guy or gal doesn't win, it's going to have a negative impact on their finances. It also says more than 3 in 5 Americans are deferring financial decisions until after the election. So again, about 60% of people out there feel like, it makes sense to defer some of these bigger financial decisions until after we know what's going to happen in the election. So I always think these statistics are interesting. So Kenny, let me start with this as a question for you. Does it make sense to do anything differently, like with our investments in an election year?
Yeah, it's definitely a great question. And I know, that if the more you talk to people, the more you realize that people have a more emotional connection to the election and what they think it's going to do with their money than almost anything. So it does make sense for people to say, look, this is a big event. Maybe I should hold off, or maybe I should change things. But this is one of those times where it is really good and important just to go to the data. And, fortunately, we have 100 years worth of data going back to many, many, many elections. And what it shows is that there's no statistical difference between election years and any other years. In fact, there is a slight overperformance of the market in years where there is a presidential election. Now, most likely you can point to that and say, well, there's only been, call it 25 in the last 100 years. If you have one good year, one bad year, that could shake it a little bit. So realistically, what that's telling us is there's no statistical significant difference between the election year and any other year. So that would tell us you really shouldn't do anything different from the investments. There's no way to make money predictably based on, what has happened in the past.
Okay. And forgive me, Kenny, I meant to give you the shout out at our intro. You wrote an article. It's up on the Creative Planning website. That the article is titled "Presidential Elections and the Market." If I was smarter, I could embed some kind of link for people to go to. I think in the show notes on YouTube, I'll just type it out if people want to look it up. But it's a great article. And yeah, you kind of show that in an election year, compared to the election year and then the year right after, there's no significant difference between returns in that election year. And to your point, if anything, it's actually slightly higher in the election year. Now it's probably, statistically insignificant. But the point being is there's not a clear like, hey, it's an election year. Let's put our investments, get out of investments, get on cash on the sidelines, wait for the election, and then get back into the market, right?
Correct. Yeah.
Okay, so I had said earlier, there's that 4 in 5 Americans, 80% of people out there think if their candidate loses, it's going to have a negative impact on their finances. And I will say finances, the CFP article doesn't distinguish like what that means with their finances. So we're going to talk a little bit more just about investments. But this idea that if a Republican or a Democratic candidate is elected into the White House, that it will have an impact on the market. So Kenny, are you seeing any patterns? Who's better in the office in the White House? Is it a Democrat? Is it a Republican? What does the market like best?
Yeah. And again, this goes back to the idea of there's being like a false equivalency out there of saying, okay, there's important economic decisions to be made. And the president certainly is one of the, if not the most important person toward what those, financial or economic decisions are going to be. So of course, there's going to be some impact on who the president is. But again, what the data shows is that there's really not. There have been, Republican presidential terms where the market's gone up really well, and there's been Republican ones where it's gone down a lot, and vice versa. And when you look at the long term, the big takeaway is that the market has in aggregate done very well during either, presidential parties. And that's irregardless of who's in Congress too. You could slice these studies out any way you want to, and there's no combination, of GOP or Democrat in the House, in the Senate, in president, where you have a predictably lower result where you say, okay, well, if this happens, maybe I want to shift away from stocks a little bit. No matter what, again, how you slice those, the market is significantly up in any combination of those, since we have good historical data going back, well over 100 years.
Yeah.
So again, it's one of those, you kind of have to remove your first biasy of thinking that this is really important for your stock positions or for your investments, and realize that, those are two very different things. While the president can make important financial decisions for the government and for, the people, that doesn't necessarily mean it's going to have a significant impact on the stock market.
Yeah. Yeah, I've got just a few things to add to our conversation before we wrap up, before that 10-minute mark. But I mean, it makes sense to me that we get these questions a lot as financial planners, as investment managers, right? It's like, and I think part of it is there's so much buildup, especially to a presidential election. We see the commercials coming out. I mean, there's the debates. We've got there's just all of this buildup, and so it's on our minds. It's in the headlines, so it's something that we think we being like a universal we, investors, has more of an impact on the investments. Or we think it has more of an impact on our investments than it does. And part of that is just because it's in our face so much. Mm-hmm. You show in your article one of my favorite charts of all time, and it's that market growth over time, pretty much since the Great Depression, and then who's in the White House, whether a Republican, a Democrat. And so you see these columns of blue stacked against red and blue and red and blue and red as like different presidents have come and gone. But overall, the market just continues to grow and grow and grow. And so the way that I kind of see it, and Kenny, tell me if I'm wrong, is, if I put myself in the position of like a CEO of a company, regardless of who's in office or who's in power, White House, House, Senate, I'm still going to do whatever I can to make sure my company is profitable. Now, I might have to adjust my strategy based on the policies in place, but I'm still doing whatever I can to be profitable. And if I'm not, my company falters. I'm replaced by a different company in that market space. And so it when you think of the market as that, it's just the groupings of all of these companies around the world. Yeah, an election may have an impact, to some extent, but at the end of the day, they're still trying to make their goods or their services be profitable as a company, grow their profits, which, overall grows this economy, which we're just seeing in all of these stock, growth charts over time. So that's just kind of how I dumb it down and think at the end of the day, these companies are still doing what they can to be profitable. And that's how we see growth in the stock market.
Yep. And that's another, pitch to stay diversified, right? In that, there could be a policy that affects a single company or even a single group of companies negatively. And so, betting on that is really difficult. But then you do just have to come back saying, okay, if you are broadly diversified, then the answer becomes, or the question becomes, can any company in America make money? Can companies overall as an aggregate make money, be profitable over the next 4 years? And if the answer is yes, which it always is, then again, as you said, that would lead us to say, okay, well, just stay broadly diversified. You're going to take advantage of those companies that are able to be profitable in these specific economic times. And you're sitting back and you're doing well. And not to say that it's always going to do well, but, all that the data shows us is that it's not who's in the presidency or what party is in the presidency that matters for that. The only thing that actually does affect this, and this is referenced in the article with data as well, is actually people's political leanings, because of exactly what you said. People who support the candidate or the party that does not win the presidency tends to underperform the investor who supports the presidency. The reason being, they do get timid. They tend to pull out of the market because they think things are not going to go their way, and they miss out on what are usually, up years, over the aggregate. So that's the only real significant takeaway, is that people's behavior costs them, not actually who is the president.
That's right. Yep, absolutely. Well, Kenny, thanks for the awesome article. Again, I'll put it out there in the show notes or whatever those are called. So I appreciate the article. I pull it up in client meetings all the time, so I reference it all the time. I should probably pay you some royalties every time I do that. So send a penny or two every time. But no, I appreciate you. Appreciate your time as always, Kenny. Have a great weekend.
All right. Same to you, Dan.
Thanks.